Welcome to Vishal and Company, where Equity Guru's own Vishal Tura, Taku Ndachena, Colin Botrell, and Maddie Grace examine the week's financial events in real terms, bringing the esoteric blur of public market activity into sharp focus. So come in, sit down, put your feet up, and enjoy.
Hey, how you doing? It's good that you're here. I'm loving it. The problem is that we don't have Maddie today, and I've got to get myself closer so you can see me through the camera. Hi, how you doing? It's this ugly mug instead. This week we're going to be doing some interesting things. We're going to be talking about the markets, of course, as always, breaking those down. Also dipping into the currency war that we're seeing, and Tesla's $5 billion raise, and also QuantumScape. That's going to be an interesting little thing. We're going to have a guest, Hassan, a little later on, talking about the vaccine rollout and some of the companies he's interested in and some of the companies he's gotten death threats about. Also, Colin will be discussing some analyst upgrades and downgrades and how you should be dealing with them. And Taku's going to round it up with the young investors' favorites. Who are they picking? Who are they going for? All right, let's open it up, Vishal. Go for it.
All right. So before we look at the markets and the equity markets, one of the biggest news for this week was the IPO madness. And we're going to do a little segment here called the IPO opportunity, sort of a play on words with opportunity there, but that's my creativity, I guess. So let's look at the first one here. And that is, of course, DoorDash, or DASH, had a nice pop. And we are seeing it get to the bottom of its first. There's only 3 days of price action, so obviously we're not, working with much action here. But of course, the other one of the largest IPO single-day movements, and was actually valued more than BlackRock at one point, and that is Airbnb, which had an IPO of $68, but opened at around $146. So I just want to give I want to go around the group here. DoorDash, Airbnb, what do you hold and why?
This one is pretty easy for me. I'm holding both, but I'm holding put options on both.
Okay, so as a trade, you're going to be doing a put option, probably, right?
Yeah.
Let's say 5 years from now.
5 years from now.
Yeah.
There now, I would go more with Airbnb than DoorDash.
Okay.
Although I don't like Airbnb's business model, it is more sustainable than DoorDash's model because of going into the fundamentals of stuff. DoorDash has really low margins, and and people are touting the 56% market share. But that has rapidly decreased since Grubhub and Takeaway and Skip the Dishes have come into the market. So I would bet that although revenues might increase over time, corporate inefficiencies will squeeze the margins where the stock will not be worth as much as it is today.
Okay.
Yeah, and Airbnb is it's a more sustainable business model than DoorDash and has higher margins. So yeah, that's my bit.
Colin?
I mean, a note for TK. One thing I've always heard is that you mess with the bulls, you get the horns. So can't fight the trend. But yeah, looks like DoorDash is actually not doing too well since their IPO there, but I think for much less sophisticated reasons than TK said, I'd be an Airbnb guy.
Yeah, that seems to be. That would be my pick too. I would rather be an Airbnb. Galen, are you going to be the contrarian here and go with?
Man, they're all overvalued, dude. I'm going to wait to see this play out. None of them are really making any profits. The model that they've been valued on is flawed. DoorDash especially. I think reality has to hit these markets. We've been so enamored from these technical services that we are literally turning a blind eye to a lot of the market inefficient or the corporate inefficiencies, as TK was talking about, that they operate under. They're just horribly bloated. The services they provide are not economical in the sense of revenue generating and profit generating. It's kind of like
That's
the emperor
true.
wears no clothes, and we're just waiting for the other shoe to drop. Do you know
So
what I mean?
it's
That's
mania and people just chasing yields here.
Yes, basically. We're in a
true.
day trading nightmare.
Yep. I mean, that's the key word you just mentioned there, Galen, day trading. So I do think, I'm not someone who actually traded Airbnb or DoorDash on the day of the IPOs, or I haven't. And I think it is more for the IPOs, the day traders. I think a lot of people that want to hold this for the longer term will wait maybe a few months, right? So something like, let's like a look at Palantir, right? This is its IPO, and a few months later, this is how it looks like. And then the other ones are of course Snowflake, very similar looking chart actually there to Palantir, same sort of market structure. And then Big C was another big one. So give it some time, well, Big C is not looking too good right now, but it has some price levels that you can work with, if you are a longer term swing trader. So I think, the way to play this, sure, the day traders and the algos and the Robinhood traders, perhaps the Wall Street bet guys are looking at those stocks. But I think for the longer term, give it some time, let it create some of these patterns and support and resistance level that we can work with. And that's what we as the swing traders and some members of our Discord channel have been doing, just being patient. But when I say that, there was one member that did play a 25% portfolio allocation in Airbnb yesterday, but it was a quick,
quick in and out. So the big thing now with these IPOs, especially these few that have been coming out after WeWork's successful non-IPO, a lot of people have been calling in the question of the whole IPO process and bringing in SPACs, the special purpose acquisition.
Now, how do they
companies.
improve on the traditional IPO?
You're basically avoiding all the SEC and New York Stock Exchange filing, and you're filing with a blank check company that has no operational business. So there's less filing and less regulation on that. And as an investor who's buying into the SPAC, you don't know what company is being bought, but you're putting your faith in the manager or the director or trustee that they, in the next 2 years, they will make some sort of purchase. The biggest one so far has been this guy, Bill Ackman.
Bill Ackman, I was just going to say.
Devilishly handsome investment manager.
I'm noticing a trend here, TK.
There's a trend here, yeah.
I like good-looking guys.
Yeah, I love the honesty.
But yeah, he has one of the biggest IPOs, but we still don't know, not IPOs, SPACs, SPAC vehicles, but we still don't know what his purchase will be. But people say that it gives the private companies an easier way to IPO and get a price that is more, get a valuation instead of a price.
Right.
So to a lot of people will be like, oh, what's the difference? Investment bankers just want to price your stock. They don't care how much it's worth. Mm-hmm. SPACs, people say it gives you the actual value behind the company. So that's the argument there. But it's interesting to see people are arguing that SPACs are the new thing.
Yep.
But we're just having $100 billion an IPO. I think we're still far away.
It has been quite popular with the bigger money, with the billionaires, like you mentioned, Bill Ackman. But there's a few other billionaires that have been, mentioning and playing SPAC. So another financial jargon acronym for us to add
to remember.
To remember. I'm just going to quickly take it back here to the equity markets in general. And it's been just one of those weeks, these last 5 days here, this is the Christmas lull. I keep referring to this, but during December, markets do tend to actually slow down just a bit. I tend to see some action till at least the Fed meeting in December, which is happening next week, I believe. So that's usually my cutoff. After that time, market liquidity sort of slowed down, but as I say this, obviously this year is very different, right? Not very many people are going to be going on vacation, traveling, and we still have a lot of big data coming out with, of course, that stimulus bill, which has to be passed by the end of this month. Otherwise, millions of Americans can lose out on their homes. And that is actually still plaguing the markets. Everyone is still looking at the stimulus talks and the stimulus deal. And right now, there's a talking point about the $300 per week for unemployment benefits, whether they want to keep that in or not. And then, of course, Brexit. Brexit is back, and it does look like there's going to be a no deal. That's what Boris Johnson has told us, that there's one agreement that us and the European Union can come up with, and that is there's likely going to be no deal by the end of the year. I've always been someone that looked at Brexit and have said that it's going to be extremely difficult to pass, because if you're the European Union, you want to make this as difficult and you want to punish Britain as much as possible, because you do not want to set a precedent for Greece, for Italy, for Portugal, for Ireland too, I believe, right? You don't want to set a precedent for these nations to follow in the footsteps of the
But
UK.
quick observation, the splitting of Britain compared to the splitting of, let's say, Portugal, the economic impact, rather than just, dismantling the coalition, Britain was a pretty big punch in the gut. I mean, Portugal or Greece cutting loose would just spell their own disaster, correct?
It's true. It's true. It is true. I mean, obviously, the British have their own currency as well, the pound, right? Whereas countries like Greece and Portugal and Italy would want to leave specifically for monetary reasons, because they could issue their own currency, which means they can weaken their own currency and lower their own interest rates. That's something Greece wanted to do, right, to get out of recession way back, right? Like we're talking years ago, but they couldn't do that because obviously the power to handle monetary policy is with the ECB. So there is that difference there, yes, of course. And then, I think the British are a larger part. But what you're seeing now is, and I want to just show you guys the currency, the British pound chart, because you're seeing something that is not a stable pound. And this has led a lot of businesses in the UK to leave the UK already. So they're already seeing a large, money leaving, business leaving, because as an importer and exporter in England, or in Britain, sorry, you can't really predict what your revenues are going to be when the currency has been fluctuating, for a while, right? And a lot of these people are now saying, you know what, makes no sense. Let's just move to Frankfurt. Let's move to Germany. And I'm talking about a lot of the financial companies as well. But I know a lot of import and export businesses are saying, you know what, no use, because the currency just keeps fluctuating wildly. Let's go to Europe. So you're already seeing business leave England and Britain. And I think Britain's economic advantage has already decreased quite significantly.
So in your mind, then, who's going to be damaged more by this move, Britain or the EU?
I think Britain's already been damaged for a while now. We're hearing that they're going to be issuing negative interest rates. Now the expectations are by summer of next year, so in 6 months' time. Market was pricing in negative rates in England in December of 2021, but now that's been pushed to summer of 2021. And I'm going to say right now, I think it's probably going to happen much, much sooner, probably March of 2021. The British have been, the currency's been fluctuating. I had a story too, I had family from England that was here when the Brexit vote was happening. And they were just watching the British pound just collapse by, 20, 30 cents. It was like a ridiculous amount in one day. So they were just seeing their purchasing power decline and just, calculating, okay, is it going to be cheaper to buy clothes here? Well, that's why we came to Canada for. No, it's not, right? So it's crazy, right? It's hurt a lot of businesses, and especially the import and export guys as well. So something to keep an eye out on. A lot of people thought it was just going to be a very easy way to get out, but there's politics. And again, the EU has to have a hard poker face here, because they don't want other nations to get any idea. So keep that in mind. I think that's going to be a big story going forward. Quickly here on the NASDAQ, we mentioned this on our Discord channel, on our trading group. But we had that breakout, and then a few days ago, a large red sell-off. So this candle here, it engulfed 1, 2, 3, 4, 5 days worth of price action, all gone. 5 days of gain, all gone in one day. And just looking at that red candle, you can tell that it is very bearish. But of course, we've had red candles like this here before, and as long as that trend is still held, we continue higher. And what we are now watching on the NASDAQ specifically is to see if we can get back above the 12,440 level here. And we tried yesterday, but the sellers stepped in and have kept pushing price below. And now we're holding support here at 12,250 here. So let's see, what the NASDAQ does. If we do get a close below this, we do continue a wave lower. But on the longer term, still in that uptrend until I think we break below 12,000, let's call it here, the 12,000 zone. So I think this is just a pullback on headlines, specifically the stimulus stuff. But nothing right now, in my opinion, pointing to a larger sell-off. But that can change, right? Once we see some of the technicals here. Quickly on oil, I just want to update you guys on our oil trade. If you guys remember, 2 weeks ago, I believe it was, we talked about this breakout here and how oil was what we were calling the COVID vaccine play, the economy opening up play, no more lockdown play. And we finally gained some steam. Yesterday, oil had a 3% gainer, and we did close higher. Brent crude was the big story because it closed above $50 a barrel for the first time since since February of this year. So that was sort of the big story, that Brent crude, not U.S. West Texas, but UK Brent crude closed above $50 a barrel. And depending on how we hold this trend, if we stay above $44 a barrel on West Texas, I do believe we will be testing the $50 to $52 a barrel here in oil. So that's something we're going to be watching. On the central bank front and on the currency war front, I mentioned how the ECB wanted to weaken the euro, and they had a chance to do it. What they did was they boosted their emergency bond purchasing program by $500 billion. So now they are pumping $1.85 trillion. So trillion, not billions, buying bonds to keep interest rates low. And they're going to be doing it for a longer time. And the euro fell against the Aussie, the New Zealand CAD, the Swiss franc, the Canadian loonie, but it didn't fall against the US dollar here. And there's already memes going up about Powell and, Lagarde sort of battling at it. And again, this is what I mean by that currency war. What a lot of analysts are now expecting is the European Central Bank will have to cut rates deeper into the negative. More money printing, throwing more money like this is not actually weakening the euro. It actually strengthened the euro. So the only thing left that they can do is now say, okay, we're going to have a negative interest rate. And that would entice people to hold dollars against the euro. Because if you're holding dollars, which has a positive interest rate, 0.25 versus the European, which is already at negative 0.1. But if they bring it to negative 0.2, perhaps that arbitrage there, and it'll make sense holding the US dollar rather than the euro, and that's what they have to do. So that seems like it's going to be the next move on the European Central Bank's front, but this is not going to end, right? We heard this news as well. Central banks step up to $5.6 trillion bond binge despite doubts, right? So since COVID, they've just been printing more money, buying up more assets, and I don't think it's going to stop. I don't think they can actually normalize their balance sheets anymore. And we've talked about this in the show in the past. Historically, central banks were lenders of last resort, and we are seeing that morph into buyers of last resort here. So I think the central bank stuff, the monetary policy stuff, is definitely something to watch. Tesla, one of our favorite companies. I know, Galen, this is your favorite company.
God damn it.
So it's almost like destiny that you were the host for today's show.
Yeah, it seems like it, doesn't it? Timing's impeccable on this one. I'm stunned.
Okay, so we talked about this.
Yeah, I've talked about this in the past, and I've always felt that Tesla is absolutely overinflated, overhyped, market manipulated, and isn't a manufacturer of vehicles, but a seller of tax credits, and has really no way forward besides having billions of dollars in its kitty through these equity financings to literally force the market in its direction. This latest financing of $5 billion is really kind of a slap in the face, because basically what this gives them, according to estimations, is approximately $21 billion moving forward in 2021 to pretty well monopolize their market. So that means that they can drop the cars to whatever price they would like. They can take that hit. They can absorb all that stuff and compete anti-competitively within the market. Now, if you take a look at some of their competitors, i.e., let's start talking about something that's really come out recently called QuantumScape. Well, it's not that product, it's the company. They've developed something called solid-state lithium, which decreases the size of the battery, increases its capacity, and basically blows the Tesla product right out of the water. Now, admittedly, we're talking about something that's still on the lab test bench. Hasn't gone to commercialization yet. This is an announcement that just came out recently, and of course QuantumScape has increased in value because of it. But what's very interesting about the QuantumScape product is that the heavy investment by Volkswagen. Now, Volkswagen in and of themselves are a car manufacturer. Now, currently, even though their cars you could say are not as good as the Tesla product, are probably still constructed much better and also in more quantities. Because, for instance, Tesla is looking to hopefully produce, if it can, and of course it always overshoots its predictions, a million cars by the end of the next year, right? And that's if they can get the German factory open, if they can get the Austin factory open and running up to speed. Because we got to understand that there's logistical problems that they have to solve that in manufacture, that just coming onto the scene and saying, hey, we can do this, isn't going to happen, right?
So you're saying Volkswagen can easily
to a certain extent, yes. They have the production capabilities, and currently they produce 11 million cars a year.
There we go.
Right? Yeah. And if you want to take a look at Toyota, which Tesla just eclipsed in market value, they produce like 20 million cars a year? Yeah. I mean, we're looking at Tesla like at a fraction of performance and actual intrinsic value, knocking the crap out of these other markets, out of these other market competitors. And I think to a certain extent, it creates an unfair landscape for competition all the way around. Now, you can say that I'm crying the blues because it's a free market and all that kind of stuff. Well, Milton Friedman once said, and he is the biggest proponent of free market capitalism, that companies are free to do whatever they like as long as they play within the rules of the game. And Tesla is not doing that. So, okay, my complaint is that they're skewing everything artificially in their favor. However, they have managed to do it. They've sold their bag of tricks to everybody down the block. They have a $20 billion moat around their company. They may just push themselves through regardless. So no matter how I bitch and complain, because that's basically all I can do, they're probably just going to make it happen. I don't know. What do you think? Is that good for the market? They're such a huge part of the S&P that if they pit out, somebody actually discovers that the emperor has no clothes, everybody's left to cover their ass and actually lose money in order to keep that afloat. Correct?
Yeah.
And we did talk about this in the past. We did say, Tesla would be foolish to not raise money at these prices, right? Like,
of course.
Some people who even say that there was a short squeeze done particularly to do this, right? In order for them to get the stock price high so they could raise money and squeeze more shorts. But here's one guy, Dr. Michael Burry, who is holding his cards, who is not being squeezed out. He is still shorting Tesla, and he did tell Elon Musk to please issue more stock at his ridiculous price. So that did happen. This article came out on December 2nd. So, we're seeing now Michael Burry versus...
with his track record, I'm siding with him, but What can I do?
Yeah, some free advice, right? So this is what he tweeted to Elon Musk. Some free advice for a good guy. Seriously, issue 25 to 50% of your shares at the current ridiculous price. That's not dilution. So that's what Michael Burry tweeted. So, let's see this, because this, I think, whenever he mentions something about his short, he is known as the big short guy.
Yep.
So could Tesla be that short there? And yeah, that's unless anyone else has any other opinions on Tesla, I know we can talk about it all day.
Just one last thought. It all comes down to whether QuantumScape and Volkswagen can produce a viable product, because Nikola is already out of the race, and they did it fraudulently to a certain extent, right?
So,
sorry, go ahead.
I was going to ask you, so does this change the landscape a lot? This battery,
there is a huge potential, because what you have is a better technology that Tesla can't even touch at this point, right? Okay. It has to get to commercialization and production, but it has the backing of a company that has already got a track record of making millions of cars in a year, who can and is already producing electric vehicles, even though they're probably 100 kilometers less. But let's face it, in the real consumer world, how much of a difference is that going to make? They're producing vehicles that can be charged with a DC charger at a much quicker rate, and for $20,000 less than the lowest end Tesla vehicle.
Right. So here's some competitors that says QuantumScape isn't alone, but they might have, like you just mentioned, Galen, they might have the advantage here.
Well, there's Lucid, there's everybody else that's out there. This isn't a closed market. It's only closed if they follow Facebook's rule book.
There we go. Okay, so apparently there's a few companies here in China. We've got Panasonic, LG, Samsung, and also, of course, Tesla, and even Toyota as well is apparently started producing its own cells, and other companies are building solid-state batteries like Solid Power and Toyota. So,
and then we have carbonless fuel, which is actually around the corner, and there's some technologies right now that are being proven in a wider sense that do extract the hydrogen without all of those horrible implications and effectively deal with remediating waste, and can be used in the vehicle that you have today.
Yeah, that's true. Do you know, I honestly completely support the competitive moat around Tesla right now is its ability to continue to raise money at higher prices.
Yep.
Once it's in the S&P, once the market stabilizes on the price, and it doesn't have that large financial backing, it'll have to dip into debt or something that has a higher burden onto its cash flow. They won't have the ability, if Elon and his team don't invest in productive uses right now, the ability to keep being competitive in the industry.
Well, see, that's the
companies like Toyota and them who have that history, they have those good relationships with their bankers, can continue to raise money, even if the stock prices are was it $8 the last time I checked? I don't know where it's at now. But they are able to continue to raise money even in situations that they can't, they should not be able to. And that financial backing itself is something that's a more longer term thing. That's what Galen is prevailing to, where if they continue to dip into the markets just for the cash, it's going to come to a limit eventually where people are going to be like, okay, you guys have taken close to $500 million in capital.
Now, from what I understand,
where is that going?
Yeah, exactly. And from what I understand, this latest financing, this $5 billion that they've financed, is actually not going towards reinvestment in the company. It's going towards buying like bonds and fucking investments.
Stock buybacks?
Yeah. I mean, like what the
you're right. Yeah. By investing in high-grade bonds, cash equivalent, or U.S. government secretary.
Do you know what? That is the biggest indication that, hey, we've looked internally at our capital projects, and there's nothing that will give us a higher return than fucking government bonds.
We're going to be demonetized on YouTube now.
I'm sorry. It's just like, it's there. It's like the writing is on the wall. Yeah. It's just like, it's so obvious they don't have anything to do with the money.
I mean, are you telling me that Tesla's flamethrowers, summer shorts, and hero models are not productive?
Honestly, I don't know where I heard this, but some of those orders are not being filled, and But I just
like their
feel
cars.
like it's going to smack him in the face, because the problem with Tesla is when you speak about him, people think you're referring to Elon, but there's a whole team behind it.
Yeah.
And obviously, I'm no CFO, but if I was one, and I was one for Tesla, I would have a deep conversation with Mr. Musk about what are we going to do in the next 5 years to keep competitive when we if the market is at this level.
Mm-hmm.
He knows from history that the stock price has a correction coming, and we won't be able to continue refinancing. How can we approach that to continue to stay competitive in a market that companies like Ford, who've been there for years, have gone bankrupt before? And so it's a conversation for them to have.
Yeah,
for sure.
Very definitely. Well, I mean, what I want to do is I'm going to move on really quickly here to Colin. Colin, speaking of all this, valuation and stuff, can you give us a broader idea of like what analysts are doing these days and how we could be dealing with how they're upgrading or downgrading?
Well, that was actually my question for TK and Vishal, and kind of the thought that sparked that, or I should say the particular upgrade that sparked that thought was a upgrade on Very Good Meat Company, I believe is what it's called. The ticker is VERY, and they just came out with earnings, and they produced like $800,000 in revenue, but they have an $800 million market cap.
Ouch.
And this analyst gave them a buy rating, if I remember correctly. So I guess my biggest question would be like, what? How seriously should investors take these analyst forecasts and that kind of thing? Like, it seems like there are certain firms that are worse than others. Like you'll get Mackie Research put out one price target with a totally different market cap and totally different share structure, and then you'll get Stifel will come out with another one, and then Canaccord is one that's kind of famous for covering. Yep. Like they gave the cannabis space back in the day just way like perfect case scenario, full legalization kind of price targets over 12 months, and obviously we can all see how that played out. So I'm just curious, how do you guys interpret that? Do you give them any weight? Do you play those at all? What do you guys think?
Sure.
Quickly, on my part, I don't really look at the analyst upgrades or buy grades. I tend to look at the technicals, right? Just the charts itself. I think TK could probably answer this a bit better, because all these upgrades are dependent on certain formulas, right? Certain formulas you learn during a CFA course, and all these other data prints, and a lot of people argue that a lot of that data prints, as those formulas and that financial analysis, can't really work in this type of market because of the craziness, right?
True. I'm a supporter. If you're having a slow Saturday after the market is closed and you want to have a good laugh, just read the analyst reports. it's a lot of them. I do understand where it comes from. Your incentive is not to write the best report or do the best due diligence with the report. It's to sell your rating, get your firm the business. So some ratings are very favorable to certain companies. One I want to talk about. Sorry to bring him up again, Galen, but there's a beautiful firm called ARK Invest. Their whole mantra is investing in disruptive companies, Tesla being one of them. And they have a valuation that is like 10 times the current price before the stock split. I don't know now. She hasn't been as public recently, so that's something to notice there. But yeah, they have a high valuation. And the analyst who wrote the valuation is a big Nikola Tesla fan as well. So I'm like, okay, so there's no bias with your valuation, and it's somebody else's judgment about the value of a stock. So it should always be the last thing you look at if you are investing in companies. If I was to say which firms, I would probably say look at the banks last, and look at the buy side companies first. Look at the investment managers first, and look at the banks last. Banks have more of an interest in giving great ratings because they are selling stock and IPOs and such.
Who are some
but
of the
investment managers?
Sorry, who are some of the buy-side investment managers that people would pay attention to?
Good question.
The Bill Ackmans, the Michael Burrys. Sadly, he doesn't actually write any of his reports, but I think internally he does. But more of the hedge funds, these guys are the buy-side analysts who try to take away from the market and analyze the companies completely separate from what's going on with the banks. But not to drag this on for too long, but in 2000, the biggest problem was analysts' valuations of tech companies. Because, like Vishal said, some of the normal metrics didn't work anymore. There was no price that was too high. And since then, there's been a complete reform on Wall Street, firewalls between the research department and the investment banking department to try stop that. But nothing is stopping me from going to my colleague and saying, just push it up by 2%. We need to sell their stock. We need to do this. There's nothing stopping you from that. And a lot of banks have been fined for it, but it's just a slap on the wrist compared to their bottom line. So yeah, it's my opinion on analysts is just to be really careful with them. Yep. But if you want to have a good laugh on a slow Saturday when the market is closed, unless you're trading Bitcoin, yeah, just have some laughs there and see what they're saying.
Love it.
But I think we should also mention a lot of people who don't follow the markets on a day-to-day basis, right? If they do have a 9-to-5 job or they have other things running a business, I mean, they tend to look at this, right? They'll come here and be like, okay, I can't really read a chart. I don't really understand this whole idea. I mean, okay, this they can see, right? Earnings are going down all the time, obviously. But then, when you see an analyst, right? Certain analysts or two analysts are saying, hey, it's a buy. Those guys can't be wrong, right? That's what they do for a living, right? They look at these stocks for a living, and maybe I should put my hard-earned money in this company because this bank and this fund and this financial analyst is saying, hey, it's a strong buy or a buy or a hold. So, there is a market for this, right? Obviously, a lot of the, like I said, the people who don't follow markets on a day-to-day basis. I would even say some of the mutual fund, guys who portfolio managers for mutual funds and those type of funds as well. This whole industry, right? Everyone has an opinion, and
that's true.
Building a case for that company, and if it's mathematical numbers, if it's undervalued, and this type of recommendations, that can be a case, right? That can give you some
a starting point, or that's true. Yeah, that's so true.
That's really what this industry is, right? Everyone has their opinions. Some people will say you're wrong. Some people will say you're right. And, maybe one person will be right next week, but then the guy who report 5 years from now will be like, hey, see, I told you 5 years ago it was a strong guy.
That's true.
So, that's how.
So basically, it's an industry of weather predictors, correct?
Well, it was Warren Buffett, right, who said that Wall Street is the only place in the world where people who are driving Bentleys will get advice from people who take the subway back home.
Yeah, right? It's the only place. It's the only place.
That's what he said, right?
So in the end, analysts are only part of the pie. They're not the whole shebang.
I think so.
Take it with a grain of salt.
Yeah, okay. I think so.
Now, Taku, I'm very interested. Who are the faves of stock picks now that we're talking about analysts and stuff? Who are the young investors actually turning to these days?
Oh, this is perfect. I have a bit of a monologue to go through.
Ooh.
Trying to conceptualize these companies because a lot of people feel like I can be a pessimist when it comes to the market today.
No, really?
And full transparency, I am a pessimist about the market today. But on the show, I do have a positive side. And I have a little graphic. There we go. Hopefully it's clear for people. And it's 17 companies that a very successful investor, Jim Cramer, is a famous TV personality on CNBC for his Mad Money show. It's kind of like a sports thing that he does, which makes it more interesting for a lot of people. So he brought up an interesting graphic of 17 companies that he says a lot of investors have been watching. And being the nerd I am, I took a step back and I'm like, oh, wow, you know what? What's there's the guy in all his glory. But yeah, I was like, you know what? What's going on here? What's behind a lot of these companies outside of Amazon and Netflix, some household names, and Tesla? Who's Zaclear? Who's Ring Central? Who's HubSpot? Why are they going up 128%? What am I missing? So I just drew this up and I was like, let me kind of look at this and really dig deep into what's pushing the economy. Are we at a stage in time where we should listen to more of the young investors and traders and not listen to the cynical institutional managers and the analysts again? Because the analysts are actually down 2% for the year. And 800% compounded, but for the year 2% down. And I mean, if you had just believed in some of these young investors, some of your stocks would be up 400% for the year and 600% for the year. So I was like, okay, the first thing I looked at was the general performance of the average. I had invested at the beginning of the year. I would have made 196% on average if I had invested at the beginning of the year. The U.S. economy, by the way, U.S. economy, year to date is down 2%. So you would have bet against the U.S. basically, and you would have done better than the U.S. economy. The market cap for this group is close to $3.2 trillion. The U.S. economy produced $21 trillion in finished goods and services this last quarter. So it's like they are a big part of the economy. They had $120 billion in sales as a group, and they made $9 billion in profit. Obviously, some of them were unprofitable, and companies like Amazon are leading the push in that. They had, of the total money supply, I think the total money supply, the M0 money supply is close to $2 trillion now. So that's the most liquid money in banks and treasury bonds. The group had a total of 127 billion of that total money supply. The group also had $149 billion in debt, and the total private lending was close to 2 trillion as well, for all private companies, so public and private firms. And I know these numbers to a lot of people can seem pretty overwhelming and confusing, but essentially it just shows you that, okay, this group of 17 contributed almost 8% of the total market capitalization in the United States of 5,000 companies. Yeah. This group of 8. And I was like, okay, maybe the young investors are onto something. Then you look at the industries that a lot of these companies are in: the electric cars, Netflix production companies, e-commerce. It's mostly techie, new wave companies. We've seen also recently people getting into more resources, lithium, probably because of Tesla on that one. But it's mostly people betting on the future. And Jim Cramer elegantly ends his segment with, these investors are not worried about expectations. They're worried about the future. And that has never been so true like today. But as an investor today, you'd step back and kind of look at this and say, okay, these companies obviously contribute a lot to the US economy. Some of them are going to be there. Some of them, I don't even know their names. If the vaccine is coming out, where is Zoom going to be in the next 2 to 3 years? Where's Shopify? The only Canadian stock there, by the way. And I think it's actually larger than RBC now, Shopify. Where are these companies going to be? Should I buy in now? Am I too late? I wouldn't be going in as of now because most people are watching them. But now I'm fully aware that I should watch the list and see what happens in the next, get a buying point that's more adequate for myself without risking too much of my own capital. And I don't know why in investing people feel the need where if you have missed the train to jump on and grasp at straws, you can wait for the next train to come in, wait again and wait again, because on average you have a 30-year investing period most people have a 30-year investing period, and you don't have to swing at every single thing that crosses your way. You can take time and actually process the information in a more, I hate using this word because it makes me sound like an economist, in a more rational way, and then go in when the time is right. So yeah, that's my bit of a monologue there about the 17. And now I ask the round table, of the 17 companies, looking at that, knowing you want to put in money for the next 2 years, would say, I'll throw in Airbnb and DoorDash in there as well. Where would you put your money, not knowing what's going to happen in the next 2 to 3 years? That's where a lot of investors are sitting right now.
Personally, I think there's a really big push to kind of support smaller businesses and not shop with Amazon. But it also does seem like that retail footprint's still shrinking. People are still, probably for the long haul, are going to be, mostly doing all of their shopping online. Or most of it. So personally, I think I would lean to a Etsy if I was to pick one on that list, or Shopify, because it does still kind of empower the smaller people.
That makes sense.
I would have done Etsy just because it looks cheaper, 170 versus Shopify, which is over 1K.
Yeah.
Ooh, yeah.
Another thing I would do too is I've known some of the share prices of some of these companies, and honestly, Virgin Galactic, right? If you're looking at something undervalued, I mean, I don't even know if the business is going to be around, but at $32 a share, right? It's cheap compared to everything else on this
in the list. Yeah.
Right.
What other companies are offering trips to space though? That's the
maybe 10 years from now, right? Maybe 10 years from now. But this is the whole idea of like chasing yield, right? In this type of market environment, I think we're going to see people like chasing things that are cheap compared to everything else, because nothing's, they haven't run up like all these stocks here that I am just typing up, and all of them are showing nice pops like this, right? And that's why, I'm personally bullish for even the small caps and the commodity space, because I think that's very undervalued. We mentioned this earlier too, right? A few weeks ago with energy. Keep undervalued, and energy's having a very nice pop. This week, this was our ExxonMobil play that we mentioned a few weeks ago, even on our Market Moment and our Discord channel, right? When it broke off about $36, already at 44. So, I'm looking at this where people, it's a mania now, right? Maybe people aren't looking at fundamentals anymore. It's all about, hey, this is cheap compared to that. People have this Pavlovian response now that you always buy the dip, stocks always go up. They never go down. So we chase all these.
We chase that. That's so true. Yeah. That's so true. I was actually going to say that. And perfect. Galen, I'm assuming short Tesla, buy Netflix.
I don't have the strength and confidence of Michael Burry, but I do feel that way. I think the market at this point is incredibly top heavy and based on FOMO. What Vishal was saying in regards to finding the actual deals, I think holds true. Look for the markets that have been depressed because of this sort of distraction. For instance, I've been making a little bit of paper money. I'm not trading this one on that one, but at Occidental Petroleum. And it's not something you would actually be, interested in or go like, oh my God, that's even Exxon. It's nothing that big. But look at its performance, right? Finding other small things that people aren't. United Rentals, Here's another thing that people aren't paying attention to, but it's involved in any constructive effort across North America. Look at that, right? And it's a nice, steady climb, right? These are long-term value investments that have real assets and real business.
Yeah.
Right? And I think that really is it. I mean, great, you can say that these 17, wow, man, I fucking made money like crazy over the last 6 months. Let's wait 5 years. Let's see what happens when those markets that they have a monopoly over at that point in time actually mature, and see what happens when we figure out how that market is actually going to play out. I mean, I'm going to miss out on the short term, but over 40 years,
you will do better over average than most people who would have refinanced their houses 6 times.
Exactly. Totally.
But yeah, I completely agree. And that's kind of what Jim Cramer ended off with is it was kind of a backhanded compliment to the young investors saying, hey, I get it. You know, you're making a bet on the future. But always remember what pushes this is the value behind it. Don't overpay just because you're expecting things to go 100% up. And I think the biggest misconception, and I don't know if it's a joke now, but people take it more seriously, is stonks go up. And they only go up.
Yeah, absolutely.
So that's the attitude right now with a lot of people, especially with the Fed chair supporting the market with $500 billion in the last quarter. I'm like that will prop up the stock market and make a lot of people feel like geniuses. But to end it off for my part, I think it's like try to never mistake a bull market for genius.
Yep, exactly.
Yes. There's lots of artificial enhancements and support for what's going on right now. Thank you very much, TK. That was a really very good in-depth sort of examination of market mentality right now. And basically what I'm taking away from what you said is, sure, there's going to be a lot of stuff in the short run, but keep your mind on the next 20 years and see what actually happens. Well, that pretty well wraps it up for today. We were expecting, hopefully, to have a friend of ours, Hassan, pop in for his expert observations on the biotech industry and pharmaceuticals in particular, and what's going on in regards to the vaccine rollout and who are the players and who are the fakers. We'll bring him back next week and just tackle that again. But what I'd like to do is thank all of you for showing up, and thank you for listening to us. Don't forget to hit subscribe on our YouTube channel. We'll keep showing you stuff like this if you appreciate it. All righty. Take care, everybody. Bye.
Thank you, everyone.